Hello, one and all present here. This is Amit Kumar Singh. Welcome everyone to a fourth session on analyzing the financial market. So when it comes to financial market, so far we have discussed about equity instruments. So when we talk about equity instrument, we have two kinds of equity instrument. Either we talk about in the form of ordinary share, or we should know about preference share. So preference share as a word, it's not that much popular in trading market. Many people who trade in the market, they themselves don't know much about preference share. So preference share are redeemable equity instrument. They are issued for a definite time period, while they don't hold the ownership right. When it comes to ordinary share, like the share what you get when you bid in an IPO or while trading in the market, the share what you get, those are ordinary shares. So when we talk about ordinary shares, there you get the voting right, there you get the ownership right. The ordinary shares, when we talk about, they are irredeemable equity instrument. They are there till the infinite time period. Okay, till the time the company does not get bankrupt. So here the word what matters is something called face value. So whenever any company come up with an IPO, they always mention something called the face value. So face value become relevant when the company get bankrupt. It is more relevant in the case of debt instrument. So when we talk about debt instrument, that time I'll talk more about face value. But as such, you know that the possibility of any company getting bankrupt, that too in India, is very minimal. I'm not talking about small cap, some penny stocks and all. I'm talking about large cap or mid cap stocks. Definitely, you expect them, they will be exist. So in order to make sure that they remain as a liquid and you can keep buying and selling them from the market, that's why we have stock exchanges. So already you know about these concepts. So we have discussed about whenever the company come up with an initial public offering in the primary market, how the whole process happens. If I give you a little bit more glimpse on this part, okay, like I'll just give you an information about one IPO possibly which happened in the month of December. So this video I'm recording on December 2023. So here I'll giving you information about IPO, and the idea here is to give you some form of terminologies which you should be aware about while understanding the market. Like here, two companies were there, like DOMS Industries and Indian Setup Finance Corporation. These two company came up with an IPO in 13 December. Okay, and the size of the IPO was 1200 crore. So you should get an idea about how things happens and what is this IPO, initial public offering, is all about. So here is the definition of IPO, that initial public offering is the mechanism by which privately held companies, they offer share to the public, aiming to generate equity capital from the individual investor. You are getting right. So company is in need of fund. So what company do? They dilute their ownership, certain percentage of ownership they dilute. And by diluting this ownership, they dilute in the form of discrete unit, which is called as shares. And when they dilute their ownership in this form of discrete unit called shares, ultimately those people who participate in buying these shares, then those people are called as investor. And in order to buy these shares, they have to pay some money. And when they pay that money, ultimately the company get the money. So once the company got the money and these individual got the ownership, so what is the possibility that the company should work for the best interest of the public, and what is happening with the company? In order to know everything about that, what is the possibility that you can trade on that ownership? For all that, the company have to list themselves on the stock exchanges. So that what happens. So here, like you can read about this. So before this, two company, DOMS Industry and Indian Shelter Finance Corporation, before these companies, there's a IPO of two companies which was Tata Technologies and Gandhar Oil. These two IPOs were very famous. Okay, so many participants have participated in these two IPOs and they made lot of money. So like you, if you see this Tata Technology IPO, it was price band of that was 475 to 500. So 475 to 500, where 475, this is called as floor price and this is called as cap price. And the difference between floor and cap should not be more than 20%. Okay. This form of issue is called book building mechanism. So whenever the IPO happens, this form of IPO issue is called as book building mechanism. Okay, so in the book building mechanism, the price discovery is being done where the investors either they are retail investors or QIB or HNIs, they bid in the IPO between these price band. Okay, depends on these price band, they bid. So like giving you example about Tata Technology, the price band of that was 475 to 500, and the stock is right now trading at 1192.55. So imagine you, if you have bidded in the IPO and you got one share, maybe 500 rupees, maybe you bidded for the max, definitely it would have been oversubscribed. Imagine the kind of return you are getting here. So it got listed at 1200 on NSE. Imagine the kind of premium you would have got while participating in this kind of IPO. While talking Gandhar Oil, it was listed at 298 rupees, premium of around 76.333% over the issue price of 169 rupees. So issue price of this IPO was 169 rupees and it got listed at 298 rupees. Issue price basically means that once these investors they participate in the IPO normally runs for the 3 days, where QIBs only participate for the first 2 days, and the retail and HNI they can bid for 3 days. Once all this been done based upon demand and supply, ultimately the issue price is being determined. So anyone who has bidded at the issue price or above the issue price, they get the share at the issue price. So you got to know about. So these IPOs were oversubscribed by 64 to 69%. You can understand the kind of demand these IPOs were having. This oversubscribe basically means that imagine the company were ready to sell 100 shares to the investor, but 6,400 share demand was there. So that way you can understand. Then here the company information is given. Then talking about this, like you know that IPO runs for 3 days. So for this company, the IPO is running between 13 December to 15 December. This is the price range. So always normally whenever the IPO happens, it is always done in book building method, where the IPO size is around 1200 crore, where out of this 1200 crore, 350 crore would be the fresh issue. Like from this out of 1200 crore, 350 crore rupees of shares they are diluting freshly in the market, while the 850 crore is basically of offer of sale. Offer for sale means the existing certain promoter, they some form of the ownership, they might sell and they come out of the whole process. Okay, it happens that whenever the company is in the initiation stage, many venture capitalists or seed investor, they invest in their money into this form of small setups, and then gradually when the company become big, they sell out and they come out of the issue. That is a very common phenomena. I believe you must have heard of venture capitalist or seed investor. So around 850 crore of the money, whatever they'll get, there would be some form of venture capitalist who definitely would come out of the issues. Okay, the face value is 10 rupees. Normally, whenever any IPO happens, the company put the face value of the share normally at 10 rupees only. Gray market premium means that there's a speculation that although like that this will be oversubscribed only, and that if you bid anything below 790 rupees, you're not gonna get the share of the company, and that there's a very high possibility of oversubscription, and there's a kind of OTC market, over the counter market, which is not exchange based scenario. There is is the other form of market where possibly they are certain investors who are actually trying to buy the share of the company, not in direct form but in an indirect form, that it happens before the IPO. It happens so before the IPO, where the people are ready to pay a premium of 400 rupees over this price. So you can imagine that around people are ready to pay around 1200 rupees for getting the share of this company. So imagine the kind of demand what this stock possibly will create once it come up, once the IPO is done and it got listed in the market. Lot sizes is 18, means if you want to participate in the IPO, you have to buy minimum one lot, and in one lot you will have 18 share. So imagine if you want to participate in the IPO of this DOMS industry, if you are retail investor, or maybe you don't have too much corpus. So if you invest for one lot, then in one lot you have to pay for 18 shares, and one share is, if you really want to get the share, you have to pay 790 rupees for one share. Otherwise, getting the share in the primary market is impossible for you. The same thing, once the company will get listed, you can imagine what price it might be trade in the market. So if you want to get the share, you have to pay 18, you have to pay 790 rupees. So this much amount of money you have to pay through your ASBA account. ASBA account supported by block amount. Okay, so through your account, you will pay this money, and ultimately, 3 days the IPO, 3 days IPO runs. Once the IPO get runs, after that they decide the cutoff price or the issue price, and maybe 19 or 18 December, the whole process will be done, and then ultimately on 20 December, the stock will be listed on the market. Okay, so I'm recording this video on 29 December. So possibly I can check the performance of DOMS industry. Imagine if I go to DOMS, or if I go to moneycontrol.com. If I go to moneycontrol.com to check the performance of this company, DOMS Industries. So it got listed on 20 December only. So you can see this company is trading around 1253. So yes, see the kind of premium you would have got if you have invested in the IPO of the company, where on 20 December only it got listed around 790, above 790 definitely. And then see right now it's trading around 1252. So you can see the performance of this company. So it opened at 1270. You can see the performance of this company. So today is trading today the stock is trading in bearish mode. You can see the candlestick is actually going down. It's showing a downtrend. Possibly technical concept is showing that this stock is actually trading in negative form. So you can see this. Anyway, we'll discuss about technical analysis and all later on. So I gave you a picture about how the IPO happens and all. So this, like, you can see that before the IPO, the promoter shareholding was 100%, and from this IPO they'll dilute their ownership. So after this IPO, the ownership pattern will be restricted to 74.97. So you can say that how much they're diluting, 25.03%. Some You can say approximately 25% of the ownership they're diluting, and from this they will raise 1200 crore rupees from the market. Okay, and when you see this IPO, around 75% of this offer is reserved for the QIB, qualified institutional buyer, while 15% for non-institutional investor. Non-institutional investor means HNIs, and 10% for retail investor. I hope you understood this. You can, if you want to know about this company and all, imagine if you are referring this information before the IPO, you can see their cost sheet, you can see the P&L account and all, you can see the EPS and other ratios, the like return on net worth, return on capital employed, return on equity. Already, I believe last class I explained you. Capital employed basically means the total liability, that is the sum total of equity plus your long-term liabilities. So while return on equity only talks about the equity, when you talk about equity, equity means the net worth of the company, where shareholder share, ordinary share capitalization plus reserve and surplus comes under return on equity. So I gave you little bit information about IPO and all, how this happens and all. I hope you got some form of information or some form of knowledge about basically how the IPO happens and all. So we'll discuss further in this class. So far we have discussed about lot of events, like we discussed about stock market and all, how a Sensex has performed, the ratio of GDP to market capitalization of our NSE. Like recently, I was going through one article where they're saying that the market capitalization of Nifty has crossed $4 trillion, while our GDP is around $3.5 trillion. So you can see clear appreciation of market capitalization by GDP more than 1.15 to 1.2. So that way you can see how much market is over optimistic about Indian economy. It may be because of the current government. Okay, and again, the next year we are having our own election. So there are many reasons are there for all these intentation. So we'll discuss all this thing as the class progresses. We'll discuss more on these part. Okay, so now talking about one company like as on sorry. So as on 19 December 2023, I'm just discussing like how trading happens and all. There's a company called Coal India. Its share is trading around 360.80 rupees, and where it has shown an appreciation of 13.15 or 3.78%. Although Coal India IPO, if I'm not wrong, it was one of the largest IPO of India, around 15,000 crore worth of IPO was of Coal India, and this was done, if I'm not wrong, in October 2010. Okay, let me just show you this. Coal India, yeah, IPO, it was priced around 225 to 245 rupees. Okay, and where the minimum order quantity was 25 rupees. If you wanted to buy a share in the IPO, one lot was of 25 shares. And this IPO was opened on 18 October 2010 and was closed on 21st October. So it was one of the largest IPO at that time. It was worth of around 15,000 crore rupees. Okay, so you can see this. Okay, so here what I wanted to tell you that, imagine 1 minute. Yeah. So you can see this, you can see the price at which the company stock is trading right now. It is a previous close, means 19 December, this data is taken on 19 December, 18 December, the stock was closed at this price. So that way you can see the appreciation of this much, 347.65 plus 13.15. It opened next day, the same 19 December, it opened at 346.50. Settlement happens once the trading get over at 330. Then in book of account, lot of settlement happens. So because of it, certain time you'll see gap up and gap down in the price. You don't get surprised with that. So this is the opening price on the day, and the same day, this is the highest what the stock has shown. This was the lowest of that, and this is the current price is trading. Here VWAP means volume weightage average price. When we talk about VWAP, that means volume weighted average price. That is 354.94. So if your closing price, if the closing price is trading above volume weighted average price, that means it is a bullishness. So if you want to buy, you can buy the stock. Many QIBs and intraday trader, they follow WAP as very powerful intraday technical tool for investing in the market. So if your stock is trading above the WAP, they believe it's a bullish signal. And imagine if you get a Marubuzu above that, like imagine above the, maybe if this is your WAP line. So above the WAP line, if you get a Marubuzu, a green color Marubuzu, if if it's showing a uptrend, while if you get a red color Marubuzu, if it's showing a downtrend, that shows the possibility of buy and sell signal. Okay, so what is Marubuzu? In candlestick model, we use Marubuzu as one of the term, where if you're getting green color Marubuzu means your closing price is your highest price and your opening price is your lowest price. So imagine if you're getting something like that, green color candlestick shows a optimism, means the stock is going up, while red color showing a pessimism. We'll talk more about Marubuzu and all later on. But in case if you are getting a Marubuzu above your WAP line in the stock price, that shows very strong buying signal, where you can put a stop loss at the at the at the what you say, the lower body, at that level you can put your stop loss. While imagine if you're doing short selling for the intraday basis, then you can use this as a selling signal, and at this point you can put at a stop loss. Okay, so normally VAP is used generally for the intraday trading purpose only. Okay, so VAP is very important or very powerful technical indicator. Around our trading in the market runs for 6.25 hour. So in 6.25 hour, if you multiply with 60, you will get what? 6.25. If you multiply with 60, you will get what? 375 minutes. So 375 minutes you are getting for the trading. So in this 375 minutes, you can draw 375 VAP lines, and then that can be used very strongly for deciding about your trading part. If your stock is trading crossing the VAP line, then it's kind of sideway movement. Better do not participate in that stock at that movement. If I talk about a VAP calculation and all, if I talk about VAP calculation here, so what how VAP is calculated. Yeah, you can see this. Yeah. So this like minute basis, you can take the trading data. Okay, so just ignore this time. This will always show the current timing only. I just use the now formula of Excel. So just ignore this time. So like just this is just dummy data. So you need to have high, low, close of the stock. How will you get this data? You get all this data by NSE. Go to nseindia.com and you can get the data from of the stock. Okay, you can get the data. Only constraint for you would be to get the minute by minute data. Imagine if you have that kind of powerful software which can export the data in Excel, and if you can get minute by minute high, low, close, and the volume of the stock, then your work is done. This is just a dummy data. So high, low, close, and volume. So what you need to do by using high, low, close, we'll find the typical price, where typical price is the average of high, low, and close. So when we talk about typical price, what is typical price? It is the average of high price and low price and the closing price. Okay, you take the average of this, what you get, that is the typical price. So what I'm doing here, I'm just I'm just doing I'm just adding them, high plus low plus closing. Okay, this divided by 3. So this will give you the typical price. Then you multiply your typical price with the volume. Okay, then you multiply your typical price with the volume. Okay, so that you call as VP, means volume into typical price, or you can say VTP, whatever. Volume typical price, volume into typical price, whatever you can say, this doesn't matter. So then what you do, once you're done with this, then like you do for every minute, the same data you calculate for every minute, and then you take the cumulative of this. So how you get the cumulative? This is nothing but this is simply this data, then cumulative, just add the value. Okay, just add this value. So I hope you understand what is cumulative. You find a cumulative of this. This you can call this total VTP or total VP. Similarly, take the cumulative of volume. So the volume was, this was the volume, then cumulative of this plus this, just take the cumulative of the volume, and then we'll find the a volume weighted average price, which is nothing but total your volume typical price cumulative value divided by the total volume cumulative of total volume. That will give you volume weightage average price value. Okay, and if your closing price is above the volume weightage average price value, then it shows the bullish signal, otherwise shows the bearish signal. I used here if function to generate that. Clear, everyone? So I hope you got an idea about how the VAP basically works here. Okay, then you can see here order book. So whenever you are trading in the market, so every day when we trade in the market, you want to buy certain shares, you want to sell certain shares, you can see the order book where you can see the best bid price, best ask price, top five bid prices and top five ask prices. You can see a bid price is the price at which we want to buy the stock in the market, and ask price is the price at which we want to sell the stock in the market. So out of all bid price, like when you want to buy, you always want to buy at cheaper value. So out of all the bid, the highest of that is the best bid price. And when you want to sell, you always want to sell at the highest value. So out of all the selling ask prices, the lowest of them is the best ask price. So you can see this, your bid value, your ask price and all, and then you can see the quantity. You can see the how much quantity, buying quantity, selling quantity. With this, you can understand that the selling pressure is generated on the coal India, although intraday basis it's showing a bullish behavior, but at this moment, seller are more than buyer. So next minute you can take a decision that there's a volatility is there. So although as per the demand supply, it's showing that seller is dominated over the buyer, but as per the VAP, it's showing that the it's a good optimistic movement. So better you don't take the decision right now, because to wait till the time both behave in the same manner. Then you can see the traded volume. Okay, you can see the worth of, this is the traded volume, the number of shares. Here the lakh crore, this traded volume, if you multiply the current price, you'll get the traded value. That you will get the what you will get the total market capitalization of the company. Free float market capitalization basically means with the total market capitalization, if you multiply the free float factor, you will get the free float market capitalization of the company. Free float factor, basically it is a ratio of total liquid shares divided by the total number of shares. Okay, so that free float factor basically talks about the liquidity of the stock. Okay, impact cost, I'll talk about impact cost right now, how impact cost is calculated. Then daily volatility, basically for determining volatility is nothing but it's a standard deviation. It talks about how much stock is volatile or how much dispersion, randomness you're finding in the stock. For that, you can use simple stat. If you're working on historical data, you can use standard deviation calculation. Maybe just for example, this is historical data. I can use standard deviation. So this like this. So generally, this is historic. This is the historical volatility. Normally, in stock market and all, for measuring the volatility, implied volatility is being used. Uh, that to know more about that, you can check for the VIX index. Okay, we'll talk about when we discuss about option market. That time we'll talk more on that part. Annual volatility, how that is being calculated. I'll discuss. I'll do one thing. I will do one session on MS Excel where I'll show you a VAR calculation and all, how VAR is basically calculated. What is the VAR, value at risk? Okay, so I just taken one article on VAR. So what is value at risk? So value at risk is the statistical measure which is used in risk management to estimate the potential loss in value of the portfolio due to the market movement over the certain time period with a certain level of confidence. VAR is mainly used basically to understand possibly what is the maximum loss what you can get on your portfolio. Then you have something called extreme loss margin. It is the additional margin what you need to uh, pay for the stock for the covering the mark to market settlement, ad hoc margin. All this you can just read about them, you'll get to know more about this part. So basically VAR and all, it talks about the underlying risk while investing in the stock, and based upon VAR figure and all, your broker will ask for a margin amount to be deposited by you when you want to trade in the market. Then how impact cost is calculated. So basically talking about impact cost and all, uh, how it is being calculated, that every day uh, our NSE and BSE, what they do, they accumulate data for the last 6 months. best bid, best ask. They accumulate the data for the last 6 months, and every day they take this data 4 times, where the difference between the two times should be more than 10 minutes. And the average of that, when it's being done, that would call as the ideal price. Okay. And for the stock to be traded in the market, the impact cost should be less than 0.5%. Now the question comes how the impact cost is calculated. This will give you the ideal price. So this will give you the ideal price, but when the actual trading happens in the stock, it won't happen at the ideal price. Maybe because of demand and supply uh, mismanagement and other reasons, they might not happen at the ideal price. So basically, how this is being calculated, your impact cost. So impact cost is nothing but it is the additional cost you have to pay for the liquidity of the stock. Maybe the stock is not that much liquid. Maybe the appropriate numbers of buyer and sellers are not there. Maybe you want to buy 1,000 share of the company, but maybe they are not enough seller who are ready to sell 1,000 shares. Because of this difference in the demand and supply, you end up in paying more money, okay, above that, above your ideal thing. Or when you're selling it, you may not able to sell at the price at which what you want to sell. You might end up in selling at the lower value, that just to compensate for the liquidity. Because normally uh, whenever we put an order to buy or sell the stock, we have the two option: a limit order or market order. When you actually buy or sell, you will get the two option. One is the market order, and another one is the limit order. So market order basically means at that price only, whatever the price the stock is trading, at that price the trade is being executed. While in the limit order, what happens, you put your own price. Like you want to buy something, maybe something, maybe this DOM industry, maybe what was a DOM industry share. If I show you, imagine I'm seeing a negativism. If I'm doing intraday trading, I can sell the stock of this company, because I can clearly see there's a more negative pessimism is developing on the stock. So what I'll do, I want to sell this stock, so I'll put an order to sell maybe 100 share of the stock, whatever number of shares. So there I get the two option, either market order or limit order. Market order means at that price only my trade will be get executed. If I put limit order, so what I can do, I know that it will go down further. So what I can do, I can say that, okay, I don't want to sell at this price. Maybe I'll sell maybe at 1,254. So when the price, if within the trading hour, if it cross 1,254, then automatically the trade will get executed. It will wait for the time till the time it reaches that. Okay, fine. So I hope you got an idea about this part. Okay. So, discussing about impact cost and all, imagine, consider this setup. So imagine there's a trader is there. He want to buy 3,000 share of X company. Maybe there's a X company, and there's a person is there. He want to buy around 3,000 share of this company. Okay. So if you want to buy 3,000 share of the company, there would be some people who can sell this share, right? So this is the current order book, what you can see. Okay, so then what happens? What is the ideal price? Ideal price is 13.75. What is your ideal price? Ideal price is nothing but your best bid price, 13.5 plus best. This is the best bid price. Out of all the bid price, the highest of that is the best bid price, and out of all ask price, the lowest of that is your best ask price. So if you just take the average of this, you 13.75 is your ideal price. And so normally the trade should happen at 13.75, but because of the liquidity of the stock, it may not happen. So there is a person who want to buy, suppose 3,000 shares of X. So how will you determine the actual buy price that happens? How it happens? Like for that, if you want to buy 3,000 shares, okay, so how your actual price will be determined. That would be 14 into 1000. Okay, so 3,000 share you want. So 1,000 share you get at 14, then 14.5 into 1,500. So you got 2,500 share plus another 500 share at 13.7 divided by 3,000. So this figure will give you the actual buy price. And imagine actual buy price you got is 14.2. So this all figure will give you 14.2. So you end up in buying at 14.2, although the ideal price was supposed to be 13.75. So this means that the extra what you're paying, that is because of the liquidity of the stock. So impact cost would be 14.2 minus 13.75 by 13.75 into 100. That will give you the impact cost of the stock. I hope you understood. So that is how it is being calculated. In case to imagine if somebody want to sell 3,000 share of the company, somebody want to sell 3,000 share, so they should be people know who can buy 3,000 share. So 1,000 quantity will be bought at this, another 1,000 will be bought at 13.4, and another 1,000 will be bought at 13.1. So and divide by 3,000, if you do, you'll get the actual sell price, and you can compare with the ideal price, and then you get the impact cost. So I hope you understood this part and all. So here in this session, we have discussed about the concept of liquidity in the stock. We have discussed about parameter like volume weighted average price, and how the order book of the stock is worked on. I'll spend more time on discussing on VAP and all. So you have to give me some more time. Possibly in next few sessions, I'll try to come up with a video where in MS Excel I'll show you the calculation of war and all. Here I have shown you the calculation of VAP margin and all. Here I have discussed about IPO. I've discussed about the whole mechanism of IPO, how it happens and all. So this much from this current session. I think I have crossed the allowed time what I have planned for myself for one session. So I don't want to make the session too much bigger. So with that faith, I'll just wind up this session. Thank you, everyone. I'll see you all in next session. God bless you. Bye.